Treasury Secretary Scott Bessent is sitting on a war chest of nearly $1 trillion, and he could be about to aim it at the bond market. The government's own checking account may fund an expanded wave of bond buybacks, one of the largest liquidity injections into fixed income in recent memory. The market moved the moment the news broke. The 10-year Treasury yield dropped 4 basis points to 4.7%, and the 30-year retreated 4 basis points to 5.23%. That 30-year had recently hit its highest level since 2007. This is not freshly printed money. This is cash the government has already collected, sitting in its own account. Look at the scale of what is in play. Bessent has built the Treasury General Account to around $950 billion through tax collections, versus a target of $550 to $600 billion under the previous administration. The federal debt load is $40 trillion, and the buybacks aim at a $32 trillion Treasury market. So how does a buyback work? The government repurchases its own off-the-run securities, the older bonds that trade thin. That injects liquidity, reduces supply, and can stabilize or even lower long-term yields. And the ceiling per operation just doubled, from $2 billion to at least $4 billion, aimed at the 10 to 20 and 20 to 30-year parts of the curve. Bessent says the goal is not stimulus. The goal is equilibrium. Keep the market stable and let the fundamentals do the talking. Now the pressure points. Long-duration bond funds have been bleeding. Over the last 30 days, TLT is down 2.03%, and the broad aggregate bond fund is down 0.33%. A massive buyer stepping into the long end could change that math or add to the turbulence. And the crosscurrents are strange. Yields initially dropped on the announcement, then rebounded, with the 30-year giving back most of its early declines. And in a move analysts call abnormal, the dollar dropped as yields rose. That is not how the playbook usually reads. There is a catch buried in the mechanics. The previous Treasury team treated that account as roughly a week ahead of cash needs. If the TGA gets drawn down, and officials still want it near $1 trillion, more bonds have to be sold to rebuild it. And the next debt ceiling constraint is expected somewhere between next winter and early spring. So here is the question that matters. Is $4 billion per operation anywhere near big enough for a $32 trillion market? The dashboard at the time this video was made, the 10-year at 4.7%, the 30-year at 5.23%, and the Fear and Greed Index at 68 firmly in greed territory. Meanwhile, Wall Street Bet sentiment shows barely a pulse, 0.03 across 2,748 mentions. 3 things on the radar from here. 1, the first operations begin September 9th and run through November 4th. 2, Jackson Hole, where Fed Chair Kevin Warsh is expected to deliver the keynote on Friday. And 3, tariff revenue, because Bessent expects deficit progress once court-mandated refunds are replaced by new tariffs. The date to remember, September 9th. That is when this program moves from headline to reality. And if you want to track moves like this with a real plan, click the link in the description, scan the QR code on your screen, or go to startwiththa.com to learn more. That is startwiththa.com from the Traders Agency team. That's the briefing from the Traders Agency team. Subscribe for daily market analysis. This is education, not financial advice. Trade smart.